Hey students, in this video we're going to wrap up Chapter 11 talking about financial assets, their markets, and the basics of investment. We're going to specifically look at bonds. Bonds are a formal contract where we pay borrow money and interest on the borrowed money in the future. When you purchase bonds, the amount you lent is called par value. That is what the borrower owes you at least. The time that the bond earns interest for the lender is called maturity. Maturity can range from short-term bonds of 5 years and can go as high as 30 years. With the bonds, we have the coupon rate. This is the interest rate charged each year based on the par value. The two questions that you should ask about a bond are, what are the yields and are they trustworthy? The bond yield is the bond's annual coupon interest divided by purchase price. To give you an example, imagine you purchase a bond that pays a coupon rate of 6% and its maturity is 20 years. That means that each year the bond will pay the holder $60. This is usually dispersed semi-annually. Now remember, some people are impatient and are willing to sell their bonds to an investor. Let's say that an investor pays $950 for the bond. Now the investor can expect $60 a year and $1,000 at the end of maturity. To calculate how much the investor gets from the purchase, you divide the $60 by $950. This comes out to 6.32%. That's a 0.32 more than the original bond holder. Now, this does not sound like much because they're only looking at one bond, but you times this by the hundreds or even thousands, the percentage builds up. Now, there are many different ways to invest your money. There are corporate bonds, municipal bonds, government savings bonds, treasury notes and bills, treasury bills, and the stock market. We'll talk more about stock markets later. For bonds, there are different kinds that have different characteristics. Corporate bonds are important sources of funds for companies to be able to operate. For considering purchasing a bond, the investor, you, needs to be very careful. Companies with poor ratings, known as junk bonds, are very high risk and may not pay out the interest rates you were hoping. If a company does pay out well, that money you received is counted as income and is subject to taxation by the IRS. These bonds are easily transferable in case the investor needs cash. Next, we have municipal bonds. These are bonds sold by states and local governments. Cities and states use money from these bonds to pay for parks and other projects. Because the source of income for cities and states are taxes, they are able to pay out the interest rate and are generally safe. They are also tax exempt. Hey, if you got this far in the video, the key word is ham. The key word is ham. It will show up on your quiz. Government savings bonds, or EE savings bonds, are low costing but cannot be transferred. These bonds can be willed away to a beneficiary. Treasury notes and treasury bonds are different in terms of time. Notes are short-term from 2 to 10 years, while bonds are long-term from 20 to 30 years. Both pay interest every 6 months until they mature. Treasury bills are very short-term obligations of the government, ranging from 5 to 2 weeks. These do not charge interest. Instead, they are sold at a discounted rate, and the difference is the interest rate. So let's say the Treasury sells you a T-bill for $970 that is valued at $1,000. That $30 difference is the interest at the T-bill at the end of maturity. That translates to a 3.1% interest. Individual retirement accounts, or IRAs, are retirement accounts in form of long-term deposits from individuals. There are different types of IRAs depending on what you want to invest in and whether you want to pay taxes on the deposits immediately or the time of retirement with each payout. There are different markets for financial assets. There are capital markets, money markets, primary markets, and secondary markets. Capital markets simply are a market where loans are made for 1 year or more. Long-term CDs, corporate, and government bonds that take more than a year belong to this category. Money markets are markets in which money is loaned for a period of less than 1 year. Now, capital markets and money markets can be placed into primary markets or secondary markets. Primary markets are markets where only the original issuer can sell or repurchase a financial asset. Government savings bonds, IRAs, and small CDs belong to this category. Secondary markets are markets which all financial assets can be sold to someone other than the original issuer. Corporate bonds and government bonds go into this category. Now for the other options to invest your money. You have the stock market that you can invest your money. If you want expert advice, you can hire a stockbroker to handle your money, but you would want to have a sizable amount of equity to do so because stockbrokers charge fees on each transaction with your account.
Here's a stock that's looking mighty good, I think. Whiz Bang Cola, that's my favorite drink. Looks as if their sales are going up sky high. Better call my broker and tell him to buy. Hello, Leroy. This is Lester the investor. Whiz Bang Cola's going up. Buy some stock for me.
Okay, Lester, confirming your order. Buy Whiz Bang Cola at 8 1/4.
All right.
With the internet, you could open an account and deposit your money and invest yourself. But this comes with risks, of course. The market is volatile by nature. Stock prices work on supply and demand for companies' stock. The more demand, the higher the price. The more supply of a stock being sold, the lower the price. And this is all based on the judgment of thousands of people at the same time. This is the efficient market hypothesis at work. That bargains or hot deals on the market are extremely rare, and this is because so many people are researching, purchasing, and selling stocks at the same time. It is because of this that if you invest, you must do research and understand the business that you are investing into. When you buy a stock, you are part owner of that company. Make sure you know what is happening. If you're not confident enough to invest in the open market, you can open a 401k plan with your employer if they offer that option. This acts as a personal pension fund that employers match your contributions to a certain amount. We talked previously about the importance of diversification. Diversification is important because the market can change from bull market to bear market and vice versa with little warning at times. We have two metrics to measure the overall performance of the stock market. There's the Dow Jones Industrial Average and the S&P 500. The Dow Jones Industrial Average is an index of 30 representative stocks to monitor prices of stocks in the market. The Dow uses very obscure math to calculate the change in points, so it's a lot easier to just monitor the percentage change. The S&P 500 is an index of 500 stocks to monitor prices in the stock exchange. There are two kinds of markets in the stock market, bull and bear. Bull markets are when prices are going up, people are optimistic about the economy, and businesses are expanding. A bear market is the opposite. Prices are going down, people and businesses have very little confidence in the economy. They get these names from the way that those animals attack. When a bull attacks, it rears its horns upwards. When a bear attacks, it swipes its paw downward. Alright students, that's the end of chapter 11. Please make sure that you're reading your books, follow the guidelines of the CDC, wash your hands, do not touch your face, and do not go outside. If you're still watching this, the second keyword is eagle.